In this class, I want to finish up what we were talking about in the previous class about optimal capital structure. Before I do that, just real quick review, Excel applications 6 and 7. On 6, I went through Kroger's, and so let's look at the second problem they have to do. So what you have to do in this problem, so you got Packer. So you have all the information you need to calculate their cost of capital. So you have the risk-free rate, and you have the spread for the debt. You have the risk-free rate for equity. You have the market or equity risk premium for equity. So what do you need? You need the beta for Packer. Remember on Packer, just like we did on Kroger, you're going to do 4 steps. You need to write that up in your answer. 4 steps. First, is Packer defensive or is it cyclical? They sell and manufacture commercial trucks globally. Does that sound like a high beta stock? Are they doing a durable good, a manufactured good? Are they doing a consumer staple? So that's the first step. Second step is operating leverage. Well, I'll tell you here that their cost structure is slanted more toward fixed costs. So talk about operating leverage. Does that imply higher beta or lower beta? And their debt to equity is well above that of the actual S&P 500 stocks. What does that say about financial leverage? And then look at their history and decide on a beta for your company. And then you plug all that in. You have the weights for debt and equity because their debt is $8 billion. Their net worth, their equity is $8 billion. So you have to do that. Someone was asking me, how do I come up with the beta? And you go through that 4-step process and you pick your beta for Packer, whatever beta you think makes sense. And then for the next Excel application, number 7, you're going to do the same thing that I just did with Packer, except for you're going to do revenue sensitive. You're going to pick a company. You'll talk about their revenue sensitivity. Are they cyclical or are they defensive? And then you do financial and operating leverage by going into Blackboard, and there's a file in Blackboard under miscellaneous class materials. It's down near the end called, let's see, I just saw it. Bloomberg data to determine beta. Once you pick your company, then you have this file. You just hit the equal sign and you go to the paste values data and you find the ticker for your company. If your company is not in this group of companies, there's about 3,000 of them, then you'll have to pick another company. So you might start here and make sure you find a company that you know, and that will tell you about their financial leverage. And remember, we said for operating leverage, if especially the net margin is the one you have to focus in on. If the standard deviation or net margin is higher than average, that implies they have a lot of fixed costs, or that they have a very elastic demand for their product, or if their standard deviation or net margin is below average, that means they have low fixed costs and or that they have a very inelastic demand for their product. So you'll just copy and paste this into your Excel application, and that takes care of Excel application 7. And then 8, you already know, is EVA, maybe the easiest of the entire group. So we're getting close to the end. We have one on risk management, and then we have evaluation of bonds and evaluation of stocks, and then we're through. So we're getting close to the end of the Excel applications. So let's finish up optimal capital structure. So we talked about that there is some optimal level of debt where you maximize the tax shield, and you without it being offset by the bankruptcy costs. So from that standpoint, is there anything else? Is that what firms do? They just maximize the tax shield and while trying to avoid the bankruptcy costs? Are there other reasons how firms select whether they're going to use more debt or use more equity? And there's this concept of signals. So management's preference is actually retained earnings first, because if you do retained earnings, you don't go out to the markets and borrow money or issue stock. You avoid all these signals. So retained earnings is first. They prefer debt second, and that has to do with signals. We'll talk about that. And then their last choice, issue stock. So what are you telling the market when you do each one of these? So retained earnings, you avoid all the signals. When you use debt instead of equity, the reason firms don't like selling or issuing stock is the only reason, the main reason you issue stock if you think your stock price is too high. So if you think your stock price should be $100, but it's actually trading for 150, then yeah, you issue stock, you get 150, you get an extra $50 per share, and your firm is worth. But then management doesn't want to be in the position of telling the stock market that they think their stock price is too high, and that's what issuing stock does. Also, issuing stock is dilutive. It dilutes the ownership shares of your current stockholders. So that's another reason management does not like to issue stock. Management has inside information, so anytime they do anything, whether it's using retained earnings, using debt, issuing stock, because they have inside information, because they know things that the average investor out there doesn't know, their actions are far more important than anybody else's. So their decision about issuing debt could be a belief that the stock price is not high enough, and so it's that signal that they want to avoid by issuing debt. They don't say that they think the stock price is good or too high. So issuing debt does create some problems for management. It does put some constraints because bondholders are very worried about the actions of management, because bondholders only get the coupon on the debt. They don't have any upside to the business, so they really don't want management taking risk, and they're worried about event risk, that management does something that benefits the stockholders at the expense of the bondholders. So when you issue debt, you do have covenants in your debt that do cause some problems. So yeah, this restates what I just said. It doesn't seem logical from economic standpoint, because if you look at the three choices, retained earnings, debt, then stock. Retained earnings is equity, then you have debt, then you have equity. So economically it doesn't make sense to have those three choices, but because of the signaling effect, management often prefers debt over issuing stock. The dividend policy for management, should they pay dividends or even buy their stock back, should be theoretically whether or not they have positive net present value projects. So remember, when we're doing net present value and in capital budgeting, if a firm has positive net present value projects, they should do them and not pay dividends, not buy their stock back. If they don't have any positive net present value projects, they've done every project they can do, and there's no more positive ones, they should pay out all of any money they have in excess. They should pay that out to their stockholders or buy back stock. So that's essentially what we're looking for. In practice, I mean, this is the theory. In practice, there is some psychology that dominates as much as the economics and the finance. So that's it for optimal capital structure. Your goal is obviously make sure you understand how to explain a chart like this without any captions on it. We'll have a team competition to practice that. It'll be somewhat easy because you're going to have your notes, so it's a lot different than previous semesters, but still the key is comprehension. Do you really understand what we just did there? All right, so let's switch to a whole new topic. Business combinations, firms that do mergers and acquisitions. This is not an area I have specific experience with, because USAA did not do mergers and acquisitions while I was there. I was responsible for a few analyses where USAA was thinking about investing in another firm, and those type of projects almost always came to me because no one else wanted to do them. So I got a little bit of experience. There was a couple of firms where a company was building something that could have really been beneficial to USAA, especially on the property and casualty side or on the auto loan side. And we looked at those firms. It was just not something. Most firms that do mergers and acquisitions have an entire department with specifically 100% dedicated time, versus some analysts like me just sitting there and on my spare time, I'm going to look at it, buying another firm. So it wasn't something USAA had a lot of resources in. But some firms do a lot of mergers and acquisitions, and it's a big part of their business, especially right now on the tech side. Tech companies, they tend to, like Facebook or Alphabet or Amazon, if they see any threat of competition, they tend to just buy that competition and not have to worry about it. So the value of a firm is essentially, we'll talk about this a little bit later, but essentially is the free cash flow of the firm. We talked about free cash flow early in the semester. The actual cash flow the firm is producing that is free to be able to distribute it or to build capacity, divided by the cost of capital minus how fast that free cash flow is growing. So a very basic equation. So what we're trying to do with mergers and acquisitions is somehow either improve the free cash flow, increase growth, or reduce the cost of capital. If you can increase this free cash flow, increase growth, or reduce cost of capital. Remember, cost of capital comes down when you reduce risk or you take advantage of the tax shield. If there's some way you can buy another firm or merge with another firm such that you change this formula so the value of the firm goes up. We'll talk about growth a little bit later, but growth is going to have to do with how economies are growing, where the firm is in its product life cycle, getting market share from competitors, and so that's the value of the firm. If you're looking at buying another firm, you might say, "Wow, there's one of our competitors or one of our suppliers. It's a great firm and it has really bad management. Let's take them over, fix the management," and that would be considered a hostile takeover when you want to get rid of the CEO, the CFO, bring in new management, new operations, and fix the firm. Another one might be you want to buy a firm because you like their distribution system. This was happening a lot in the 80s, in the 90s, where banks were buying insurance companies, and they were saying, "Wow, you've got a good distribution system. We can sell our products through your distribution system. You have all these sales agents out there selling insurance. Let's get them out there and sell our investment products and our bank products as well." You might increase your pricing power. So you might be 5% of the market or maybe 20% of the market. If you merge, you become 30, 40% of the market. So you can actually charge more prices. Obviously, the regulators and the antitrust concerns are going to limit that. There may be redundancies between your firm and another firm, so that if you combine, you can eliminate a lot of staff. Maybe your firm has 50 people doing something, they have 50 people doing something. If you combine the firm, you only need 55 people, so you save 45 people. So you're looking for economies of scale, or what we call cost synergies. I don't know if you've heard this word synergy before. Synergy is used a lot with mergers and acquisitions, of trying to take 1 + 1 and get something greater than 2, that the combined firm is more valuable. And cost synergies is a way to do that. You combine the firm and you get rid of the redundancies, and you got everything's the same about the firms. The combined expenses are lower, and so your profits are higher. You might acquire another firm because they have superior processes that you can take over and use. Maybe they're better at managing their inventories or their accounts receivable, or something that just says they're just a lot better. If we acquire them, we can take advantage of that. Does combining the firm give you a lower cost of capital? I've seen that. Valero is rumored to have done that when they spun off corner stores. That Valero plus corner stores made it a very complicated business, and because of that, their cost of capital was higher than it should have been. So if they spun off corner stores, the two firms would both benefit because the cost of capital would come down because the firm wouldn't be so complicated. Corner store has since obviously been purchased by another firm, so probably more in lines of the economies of scale. So these firms are being passed around all over the place. So the bottom line is we're trying to make the firm more valuable to investors by somehow taking advantage of one of these issues. And firms have all different reasons for mergers and acquisitions. If you read, there's the professor, Dr. Damodaran from New York Stern School of Business, has done a tremendous research on mergers and acquisitions, and his analysis shows that most of them have been failures. Most of them have actually destroyed the value of the firm. The combined firm was worth less than the two firms when they were apart. And his numbers show it's overwhelmingly a bad decision. And that's because management says they're doing the acquisition for some of these reasons, when really the main reason they're doing it is the CEO just wants a bigger company. The CEO wants more power, more authority. Their pay goes up if they have a bigger company, more stock options, those kind of things. That there might be more of self-serving management, self-serving incentives versus actually trying to improve the value to the stockholder. Obviously, these mergers and acquisitions can be very politically sensitive because many times the merged company will lay off a lot of people, and that becomes a major issue. I know in the presidential election back, I forget which year, but Mitt Romney, he got a lot of bad press because he worked for a private venture firm that did a lot of these mergers and acquisitions where they would lay off a lot of people, and he got a lot of bad press for being associated with that firm. But that should be the objective, is to improve the value to the stockholders. The question is, why do we want them to do this? Because if you like these two firms, rather than merging them, you could simply buy the two firms in your portfolio. So stock market can do this a lot easier, more easily than management can. You just buy the two firms. You might study the Boston Consulting Group, and they say you need to do mergers and acquisitions so your firm has a star, that is a fast-growing firm with a lot of cash, has a cash cow, which is a slow-growing operation but produces a lot of cash. You want to try to get rid of the dogs. Dogs are slow-growing that use up a lot of cash, and then question marks might be fast-growing but use a lot of cash, but you're not really sure where they're going. And Boston Consulting Group says you need to make sure you have some of all of this. And that theory has really gone by the wayside. It's not really respected as much. You may still see it in some of your class. I'm shocked that colleges still teach that theory. Boston Consulting Group itself doesn't even like this theory even more anymore. So, but you don't really need management to diversify the firm, because you as a stockholder can diversify your portfolio just a lot more easily by just buying a bunch of stocks, and you have your own stars and dogs and cash cows and question marks. Stockholders can do that themselves. So the real question is there some synergy? There's something with the combined firm that makes both firms more valuable when combined than separate. If all his management is doing is combining two firms and there's no advantage of that combination, then it's probably going to be a disaster. I remember in my graduate work we studied the American Can Company. American Can Company in the early 80s wasn't doing very well because aluminum had taken over in the can building business. Tin cans just were not that used that much, so it was a dying business, essentially somewhat of a cash cow business. So they went out and they bought a life insurance company. There's no synergies whatsoever. There's no overlap in the two firms, no redundancies. And oh, what a mistake to do that, because the management had no knowledge of life insurance. It was a disastrous combination. And that's when you get into conglomerate. You have a firm that does everything, like a GE, just does a lot of things. The stock market does not like that, because it makes the firm so complicated, it's almost impossible to value the firm. And so conglomerates historically have done very poorly. Maybe Berkshire Hathaway is the one exception, but that's a little bit different because you're not buying a conglomerate, you're buying Warren Buffett as essentially your manager of your investments. So horizontal mergers and vertical mergers are much more likely to be successful. Horizontal mergers are two firms in the same industry merge. That's when regulators get concerned about antitrust. Vertical mergers is when a firm buys either a supplier or a buyer. Those can work well. but you're trying to create some synergies such that the two firms together are more valuable than they are apart. What we'll do next session, we'll get into some of these. I'll finish up leverage buyouts. I do have a PowerPoint that I want to walk through in the next session that gives some historical data and some perspective. I was going to update it for this semester. The Bloomberg machines have some really good mergers and acquisition information. You just type MA in Bloomberg and it'll come up. I encourage you, if you have a class, some of your later classes where you have to do a major project as a team, mergers and acquisitions is often a big part of that. And I encourage you, use the Bloomberg machine to help you because its merger and acquisition information base is really strong. So next session, we'll talk about leverage buyouts, and then we'll walk through the PowerPoint that I have out there on Blackboard.